Since 2020, the Dubai real estate market has grown like crazy and reached $112 billion in deals in 2023, which is more than Hong Kong, London and New York. This raises the question, is it still worth it? Our clients, both big and small, are still making mid- and long-term investments in Dubai properties, expecting great returns. But isn't the market overheated? Isn't there a bubble risk? And surely the good times have passed, right? Well, when you look at the data, that's actually not the case, and Dubai properties are very likely to continue growing. And to explain why, we need to start with analyzing properties prices' historical growth. Wait, before you run away thinking this is about continuing the growth trend, just hang on a second. This isn't about projecting the same growth pace the market had over the past 4 years. Such market forecasts are bullshit. What I'm suggesting is we take a broader look and check how high prices are now compared to historical numbers. This graph shows the price per square foot since 2003. You might have noticed that there are 3 peak years: 2008, 2014 and 2024, and they are pretty similar. Current prices are just 2% higher than the 2014 peak, and that doesn't take into account inflation, which was roughly 16% over this 10-year period. Meaning, current prices are actually lower if we adjust for inflation. And obviously, Dubai has drastically improved since 10 years ago. I mean, it hasn't just become more livable and attractive for expats. The investment attractiveness has boosted significantly too. Golden Visa program was launched, granting long-term residency visas to property investors. The business environment has significantly improved, including enhanced legal frameworks with investment protection laws and bankruptcy laws. Also crypto. It's legal in Dubai under specific regulations with zero tax on crypto gains. Many mega projects were developed or announced, like Expo 2020, which is an 11 billion infrastructure project. Also the new Al Maktoum International Airport and huge residential areas like Greek Harbor. That one is expected to house over 200,000 residents, and the next tallest building in the world is also planned to be there. But someone might challenge this whole argument by saying, yeah, the prices were as high as they are now many years ago, but maybe that's the maximum. The market was overhyped back then, and there is no room for growth now. And that's a reasonable point. That's why we need to compare Dubai's market to other global cities. The first thing you'll notice is that Dubai apartments are actually affordable. I know that $230,000 for an average studio might sound crazy for those who live in Karachi, Warsaw or even Istanbul, but it's all about how prices compare to personal income. The median salary in Dubai is roughly $52,000 per year net, which is the same as gross since there is no personal income tax in the UAE. This means that to purchase an apartment in some of Dubai's most well-known neighborhoods, you need up to 6 or 7 of your annual income. This isn't the case for Jumeirah Bay or Emirates Hills, where an average Dubai resident would need 100 or 200 times their annual income. But let's take GVC as an example, which is a not bad area 20 minutes drive from the city center. To buy a studio, you'll need 3.5 years salary. 5 years salary will buy you a 1-bedroom apartment, and for 8 years salary you can get a 2-bedroom. The same conclusion was reached by UBS, a prominent investment bank. They compared the number of years a skilled service worker needs to work to be able to buy a 650 square feet flat near the city center. Here are the results. The estimate for Dubai is similar to what we've just discussed, roughly 5 to 7 years of income, while in New York you would need closer to 8. In London, that would be 12, and Hong Kong is the craziest one, with about 22. Another way to analyze Dubai's pricing relative to other cities is to compare rental returns. Here is another analysis made by UBS that will help us. They compared the number of years a flat needs to be rented out to pay back its price, and Dubai is on top. Well, in this chart it's at the bottom, but that's the best place to be. On average, the rent pays back the apartment in 15 years. In New York, that would be 20 years. London and Sydney are more than 30. And some global cities like Zurich, Tel Aviv and Hong Kong are close to 40 or even higher. It's worth noting that it's possible to get higher rental returns in Dubai if you know where to look. You'd need to choose specific areas and seek specific types of buildings and apartments. and we provide such property search and do financial analysis for all of our clients for free. So if you are considering investing in Dubai real estate, click the link in the description or call the phone number that's on your screens right now to get a free consultation with my team. Now, this comparison with global cities becomes even more interesting in the prime real estate segment. Take a look at this picture. It shows how many square feet of residential space you can buy for $1 million in prime areas around the world. So, 980 square feet in Dubai compares to 366 in New York, 355 in London, 463 in Sydney, and just 237 in Hong Kong. Of course, this makes wealthy individuals considering investing in Dubai. According to Knight Frank, 44% of global high net worth individuals they surveyed are very interested in purchasing property here. Actually, the richer the person is, the higher their buying consideration is. 28% of people with the net worth of $2 to $5 million are very interested in buying, while among those who possess $15 million or more, it's 78%. This hypothetical demand revealed by surveys has actually materialized with an insanely high number of expensive houses sold in 2023. Look at this graph. In 2023 alone, 431 houses priced at $10 million or more were sold. This makes Dubai the world's leader in luxury homes market growth, with London and New York as the closest competitors. The key for Dubai to keep up with this trend, not just for the high net worth individuals but in general, is obviously to continue generating demand. And a big contributor to that is tourism. According to Knight Frank, 88% of those familiar with Dubai declared an appetite to own property in the city, while only 5% of those who have never visited Dubai showed any interest. They made this survey for high net worth respondents, so we cannot use these numbers for the mass market. But I assume we can apply the insight. The intention to invest is higher amongst those who have visited the city. Tourist numbers are huge and rapidly growing. In 2023, the number of international visitors reached 17.2 million, surpassing the pre-COVID figures. 2024 is even better, promising to reach about 19 million. To fuel future growth of the city, Dubai presented a 2040 master plan that involves big positive changes in the city's infrastructure and, of course, affects tourism. They are planning to expand hotel capacity by 134% and increase beach areas by 400% by 2040. In addition to tourism growth, they're aiming to drastically increase the population to 5.8 million by 2040, which is a huge 75% increase over the current number of residents. We see this growth as quite challenging, and right now this number is just a goal, so I suggest we treat it as such. Making market forecasts based on that is too early. So what for potential investors? All of what we've been discussing doesn't mean that Dubai real estate prices will skyrocket and triple in a few years. These data illustrate that the average price points are definitely not crazy high, and there is room for growth, and Dubai is well positioned to achieve it. Also, there are a couple of things, maybe quite obvious, but I'd still like to note. First of all, any real estate market will eventually fluctuate, and there is nothing you can do with that. Economic crises, new pandemics, regional wars, and other black swans are inevitable. That's why you'd better treat real estate investment strategically, as a long-term venture. Second of all, properties are not created equal. Area, developer, type of unit, market cycle, asking price, all of that matters and is significant for future returns. And even in a rapidly growing market, one can make horrible investments, while others will thrive in a much slower market. So the real question is, how investors can outperform the market in the current and near future state? In markets that are passing the phase of crazy fast growth, it becomes critical to select projects that are in early stages, in yet underdeveloped areas, or that have great rent-to-price ratios so they can pay back with cash even if the value is not appreciated. To help you find such properties, I'll do a quick rundown of areas where to look for opportunities that are worth it. Let's start with areas that have great rent-to-price ratios. This is a simple performance indicator calculated by dividing the annual rental income by the property price. It's not a comprehensive metric, but is good enough for initial analysis. On your screens, you'll see 25 of Dubai's main areas along with their rent-to-price ratios. This data is provided by Property Finder, and while I'm not entirely aligned with their methodology, it gives us a good indication and allows us to compare the different areas. If we narrow it down to the top 5, we're left with Al Furjan, JVC, Sports City, International City, and Arjan. This doesn't mean you should jump into any of them without doing the homework, but this pre-selection is a great starting point for your investigation. Now let's talk about early-stage projects in underdeveloped areas. We've put together a list for you too. These are 13 main areas that will be developed in the near future. Projects in these areas will regularly hit the market, giving you plenty of chances to invest. Here's the important thing to consider. Not all these areas are the same. Different companies are developing them, so projects won't perform equally. Some developers might deliver almost all of the buildings in the area simultaneously, making the units you buy less unique. Additionally, some areas might be fantastic for living, but may not outperform the market as investments. If you want to know which areas are very likely to outperform, check out this video. We dive deeper into the specifics and give you the insights you need to make informed investment decisions.